The war and your wallet. Russia teetering on economic collapse and default. How can a protracted war in Europe impact the markets? And the Federal Reserve this week raising interest rates by a quarter point. That's the first interest rate hike since 2018. All of this in an effort to curb runaway inflation. For reaction, let's bring in financial analyst and the president of Zuma Global, Heather Zumarraga. Heather, welcome back to the show. Good to see you.
Hey, Tom. Good to be here.
So how does this war impact the markets and therefore, people's retirement funds and other accounts?
Well, it really does. I mean, I think first and foremost, you look at the stock market, there's enormous volatility where on one hand you have Russia and Ukraine uncertainty impacting the energy markets and commodities markets, while on the other hand, you have the Federal Reserve this week, which you noted, that increased interest rates for the first time since pre-COVID for a quarter of a basis point. And although that may not sound like much, it's at the beginning, it's like baby steps in a series of 7 rate hikes this year, and that impacts your mortgage, your credit cards, your auto loans. So any type, even student loans, any type of loan that you may have or may be getting, expect those interest rates to head higher.
Heather, as a practical matter, and we've talked so much this week about how Russia is on the brink of default. When something like that happens, when a country like Russia defaults, is their economy big enough to impact the markets? Because frankly, we may need to crater the economy in Russia to punish Putin over the long term.
Yeah, I understand there will be economic consequences, at least in the short term, as global supply chains readjust. For example, although we don't get a lot of oil from Russia or wheat from Ukraine, they are very large exports of those commodities. You know what? The world does. Europe, some European countries rely 100% on Russian oil. So then they will turn to the U.S., hopefully, if we were ever energy independent again. Doesn't look like that will become energy independent anytime soon. Look, Wall Street Journal reported that President Biden calling on OPEC countries and in the Middle East, and they didn't even take his call in the UAE and in Saudi Arabia, for example. So we need to turn back on drilling in the U.S. because we are all globally interconnected. So although we've already seen the price of oil increase, food costs are going to go up even more. But remember, before the Russia-Ukraine situation, gas, the price per barrel for oil was already at $80, and food costs were already up 10–20%, meat and poultry year over year before this happened.
Yeah, so to that point, Heather, is this kind of the perfect storm brewing? You've got high government spending, the economy kind of on the sugar high from government printing money, high inflation, you got a war in Europe, high energy prices, and now 6–7 interest rate hikes a year in a year. Could it mean a global recession? And not to sound alarmist, but there's a lot of different factors here that seem to be converging at the same time.
Yeah, right. Well, a lot of economists are calling for a potential recession, not now, but maybe in 2023, 2024, as interest rates head higher. But the one, I guess, key takeaway preventing the stock market from collapsing right now is that bond yields have been so low. I mean, you mentioned retirees at the beginning of the show. Yeah. They have nowhere else to put their money. Inflation's at 40-year highs. And so you can't hoard your cash under your mattress. And you can invest in bonds. The rate on your CDs or your money market is like 0.5%, less than 1%. You're lucky if you get anything at all. You're right. And therefore, it's forcing Americans into riskier asset classes, Tom. And that's just not something that I think that is smart.
All right, we're going to have to leave it there, but I'm sure we're going to continue this discussion. Heather Zumarraga, thank you so much for being here.
Thanks, Tom.